Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you all, as always, for giving us a few minutes of your time. We've got some topics to cover this week and an update on commercial real estate, something we don't hit all that often. It's not like the world of public stock market where companies are updating their prices by the minute. So it's a little bit slower moving. At least once a quarter, we like to drop in and see how things are going there and check on some of the investments we do have in that category. Then Andrew's going to cover the technicals and take a look at the NASDAQ and the breadth there. And then one thing we've talked about frequently here is the Magnificent Seven, and he'll update you on those important group of 7 stocks. But let's start with commercial real estate and where we are now. And I've got a couple of text points here. But the first is going to say that we've only done $90 billion worth of U.S. commercial property transactions in the third quarter. Now that we moved on to the fourth, that's a 53% drop. And I think the big reason for that is there's such a wide gulf between what buyers are willing to pay. They're constrained by interest rate challenges and what sellers are willing to let the property go for. There's such a wide gulf there. And until they come together, we're going to see a pretty dried up and stale market. Which way they come together, maybe they meet in the middle, or the market or the interest rates drop to allow buyers to come up, or the worst of those scenarios would be the sellers coming down all the way to the bottom, and that begins to mark down assets across the country. And we have a problem for banks and everything else. That's kind of the worst case scenario, but somewhere there is a wide gulf that needs to be covered before we see those transactions covered or come together to actually complete and close. That will happen over the next several years because eventually commercial real estate has loans that need to mature. And at that point in time, that will trigger a lot of transactions. So 2025, 2026 is when that should accelerate. I would say the more important point is this second one, and that is construction starts. How much are we building? And that is down to 935 million square feet, a 17% decline. And as you'll see, the lowest since 2009. And so we do have a pretty healthy amount of completions coming through. So a lot of the projects that began in even 2020 and 2021 when financing was a lot looser, now coming to completion. So those are healthy. The problem are those starting now and what the completions will look like this time next year and into the following year. And so that has implications, and some of them are good for us. Reef Property Trust is a fund that we have exposure to in several portfolios. And one of the great things about Charles Schwab moving into that platform, they do have significantly better profile for holding some of these alternative investments. And they have lowered the cost hurdle for entering those. So that may be something that you and your advisor discuss when you have your upcoming family update next year or before. So that Reef Property Trust, one thing that we have noticed inside there, so they own multi-sectors, a lot of different buildings and different groups of commercial real estate, which, by the way, when we say that term commercial real estate, I do find that most people immediately jump to think of big office buildings, when in fact, that office is really one of the smaller pieces of that puzzle. The bigger pieces are apartment buildings, or what we call multifamily, retail establishments, industrial. Those are really the biggest segment. But what they find is that there's really low vacancy. The buildings are well occupied and rents are strong. That's one, there's some positives to inflation, and that is one group that does have a positive benefit as rents accelerate. And so one impact that you'll see with the decline in starts, what they see absent another a recession between hitting now and then, which is of course a possibility, that could put even further pressure on rent. So that's just some of the high level points that we see in commercial real estate. And I will say one of the big things that could have really, I think, helped smooth over and balance the commercial real estate is really pairing some of the strength that we have in multifamily and apartments with the extreme weakness in office. Especially in bigger cities, there are a lot of studies and a lot of efforts trying to convert these vacant office spaces, because even though we've got people back to work and we've got COVID in the rearview mirror, we're topping out at about 50 or 60% of people who are fully back on premises. So there's just this wide gap between all the office space that we have and the office space that we need. And so the hope is that a lot of that can be converted. And that's where we're really falling short. And that's what we see on the next slide here, is a shortage in conversions. And the reality, and that most of you will be more familiar than I would be, and what you need to see from plumbing and what you need to see from in terms of the structural integrity of a building to switch from something that is an office floor plan to apartments. But when you add all that together, we're just not seeing anything that amounts to a major supply. So that would be, and perhaps there'll be some innovative ways to accommodate this, but we need a lot more units if we're going to see a healthy rebalance and kind of take some of this office supply offline. And that would be a good thing for renters too. Like there'd be a lot more choices and put some more downward pressure on rents. But for now, that's the way we have to see it, is that office still looks weak. And for that matter, multifamily apartments still look quite sound, as well as those other two areas, industrial and retail. So that's enough commercial real estate for now. We'll go back to public stocks and let Andrew update us on the technicals.
Thanks, Adam. So something that we spend a lot of time talking about on the Market Carver and also in our weekly allocation meetings is looking at the breadth data of the market. And what that is just a fancy way of talking about participation. Whenever we look at indices, we know there's obviously a lot of stocks that make up those indices, and we want to know how those individual stocks are performing. We often talk about the S&P 500 and its 500 stocks, but also the NASDAQ 100, one of the stronger indexes for this year, is something we also keep a very close eye on. And with the market having experienced several months of downturn, we're now starting to see things start to improve, specifically in a lot of technology growth stocks, and that's what makes up the NASDAQ 100. And so the first chart we're going to look at here is looking how many of those 100 stocks in the NASDAQ 100 are making new 52-week highs. So the chart we can see in the green is new 52-week highs, in the red is 52-week lows. And so if we go back to last year at the market bottom, we can see we started seeing a lot less 52-week lows. We weren't seeing this expansion of stocks declining like we were seeing in the index. Now we fast forward to today, and with the market starting to recover, we're starting to see that expansion once again of stocks hitting new highs. In fact, as of last Friday, over 15% of the NASDAQ 100 was hitting a 52-week high. So we're very encouraged by that expansion and breadth, that broadening out of participation. Tells us that while we may have a small group of stocks that are being the market leaders, we are seeing a broadening out of stocks that are starting to increase in value and adding or contributing to the overall performance of the NASDAQ 100, which obviously is going to roll over, and as well as the S&P 500 and all the other indexes that we can track. So I mentioned that there is a small group of stocks that has been the market leaders, and it's one we've talked about several times on these market carvers, and that's the Magnificent Seven. It used to be called the FANG: Facebook, Amazon, Apple, Microsoft, Google. Then we started introducing Tesla and Nvidia, and it kind of expanded a little bit beyond just the FANG group. But this group of stocks has really been the primary driver for sending the market higher. So the chart that's on your screen right now looks at your cap weighted, your regular S&P 500. On the very bottom is an equal weighting of the S&P 500, meaning each stock is given the same amount of weight within the overall index. In the middle is our mega caps, our big guys, the Magnificent Seven, and we can see they've done very, very well. Even when the market was starting to decline over the last couple of months, this group pretty much just went sideways. We didn't see a lot of selling in these market leaders. And in fact, what we started discussing in our allocation meeting was if these seven stocks can improve and recover, get back above that August low, looking at that blue trend line on the chart, then that would be very beneficial to the overall market. And that's exactly what we saw happen. We saw investors pile back into these seven favorite stocks, and they went back off to the races, recovering in their own price charts, starting to really appreciate in value, and that's dragged the rest of the market with it. In fact, over the last 1 month, the market was up as of last Friday about 1.4%, and just three of the stocks in the Magnificent Seven accounted for basically all of those gains. What Apple did, Microsoft, and Amazon, they contributed all of that 1.4% contribution for the S&P 500, meaning a lot of the other stocks actually, whether going down or flat, they weren't contributing, helping push that market higher. We just were relying on a handful of few. Now, this traditionally is not something we were encouraged by. We want to see broad participation. We want to see a lot of stocks contributing, providing that good foundation for the market to go higher. But when we just have a handful of stocks, that's where things can become a little bit more risky. So far, right now, those 7 stocks are performing well. And if that continues, then that can continue to be a positive contribution to the market. It's if those trends start to change and go lower, similar as we saw in August, September, and October, then they can have a negative impact to the overall market. And if they start to decline, they could drag the market with it. And so we're very focused on how are these stocks performing? Where are we finding leadership? Do we start seeing leadership broaden out? Or is it just going to remain in these handful of stocks? And if that changes, then we know that that's going to have a significant impact on the overall market. And that's something we're keeping an eye on and knowing if we need to make adjustments within our portfolios as well. But right now, the Magnificent Seven are still magnificent and they're still trying to carry the market higher. It's anyone's guess how long that will last, but we're keeping a close eye on it every single day.
Absolutely. And excellent. Thank you as always, Andrew. And thank you to all of you for giving us your time. As always, 800-928-4001 is a phone number where you can reach us if we can be of service. And we are just now a week out from Thanksgiving. So hope everyone here watching has a great time with your family and, of course, have safe travel. So thanks again and have a great weekend.